Every year, things get more expensive. Or do they? You see, it's not always the case that the goods and services we want and need are increasing in value. Instead, it's the currency we're using to pay for those goods and services that's losing its value. The US dollar loses around 3% of its purchasing power every year due to inflation, and has lost over 96% of its value since the Federal Reserve started printing money in 1913. Some of you will already know this, and it might be part of why you're interested in cryptocurrency. But riddle me this. What happens when billions of USD-backed stablecoins are being printed and injected into cryptocurrency markets? Is it a problem that stablecoin trading pairs make up more than 50% of all the daily trading volume in crypto? And what would happen if the market cap of a stablecoin like Tether became larger than Bitcoin's? These are just a few of the important questions that nobody in crypto seems to be talking about. And today, we're going to find the answers. Before I break out my magnifying glass, I have some intel to share with you. I am not a financial advisor, and nothing I say in this video should be considered financial or investment advice. It is on you to do your own research before making the Wall Street Bet subreddit proud by YOLOing into crypto. My name is Guy, and I am the lead detective here at the Coin Bureau. On this channel, I showcase the findings of my surveillance operations in the crypto space. Tokens, exchanges, DeFi shenanigans, tutorials, market analyses, no mission is too big or too small for this guy. So if this is your first time here, it's nice to meet you. Consider taking the time to subscribe to the Bureau and ping that notification bell so you get notified when I've finished my latest mission. You can also use the timestamps below to optimize your viewing experience. I don't mind if you decide to skip around. Alright, that's enough jibber jabber. Time to take a closer look at what stablecoins are doing to the crypto market. Ever since they started emerging in 2014, stablecoins have been a controversial, albeit admittedly useful asset class in the crypto space. For those unfamiliar, stablecoins are cryptocurrencies whose values are pegged to a more stable asset, such as the US dollar. While there are also stablecoins pegged to denominations of precious metals like gold, this video only concerns those that are backed by fiat. Stablecoins make it possible to quickly actualize your gains and protect against losses without having to cash out using a crypto-to-fiat payment gateway, which is what you had to do before stablecoins were introduced to the crypto market. I can't imagine how stressful it must have been to wait for your Bitcoin to arrive at a crypto-to-fiat payment gateway during a bull market. There are roughly 200 stablecoins available today, and most of them work in more or less the same way. To issue a stablecoin of any kind, an equivalent amount of the asset it represents must be locked up somewhere in a centralized or decentralized manner. This means that for each USDT token issued, Tether must have an equivalent amount of US dollars sitting in their bank account somewhere. Sorry folks, I couldn't keep a straight face with that one. Questionable collateral is just one of the reasons why stablecoins have been controversial. Many in the crypto community believe that stablecoins have been used to manipulate Bitcoin's price. What's more is that most of the largest stablecoin issuers are centralized. This means they can actually control the tokens they have issued. Both Tether and USDC work closely with law enforcement and have a history of freezing wallet addresses which were suspected of being involved in criminal activities. It also turns out that stablecoins are not all that stable. You'd be hard-pressed to find a single stablecoin which has maintained a perfect peg during times of high volatility. Despite these concerns, stablecoin share of the overall market cap of the crypto space has been growing exponentially over the past year. Tether's market cap alone is projected to surpass Ethereum's by 2022, assuming Ethereum stays at its current price, of course. Now you might be asking, but what does all this mean, and should I be concerned? The answer to this question has many layers. Let's start by looking at what these stablecoins have been up to. The market cap of the 8 largest stablecoins has grown from 5 billion to over 22 billion over the last 6 months. Most of this growth has come from Tether, which went from a market cap of 4.5 billion to nearly 17 billion during this period. As you can see, there appear to be 2 distinct surges in stablecoin printing over the last 6 months. The first wave of stablecoin printing seems to have begun after that flash crash in March and continued until early July. The second wave of stablecoin printing corresponds with the DeFi boom, which began in mid-July and continues to this day. The reason for all this stablecoin printing is painfully simple: demand. Stablecoins are used as a hedge against volatility. So, when you see big volatility in the crypto markets like we did during the March flash crash, expect to see a spike in demand for stablecoins. You can also expect to see a corresponding increase in supply from stablecoin issuers to satisfy that demand shortly afterwards. A study published in June this year by the University of Hamburg and the Blockchain Research Lab found exactly this result, noting that, quote, "The issuance of stablecoins follows cryptocurrency market downturns." The popularity of stablecoin-centric DeFi protocols like Yearn.finance and Curve Finance likely supercharged this demand over the summer. The total value locked between these 2 DeFi protocols alone exceeded $2 billion during that time, meaning they held roughly 10% of the total stablecoin supply. A quick glance at the largest Tether wallet addresses on Etherscan further supports this demand angle. Most of the largest USDT wallets belong to cryptocurrency exchanges and DeFi protocols. What's more is that when PayPal announced they would be supporting cryptocurrencies in early 2021, of the 450 million USDT that were minted by Tether, 70% of the initial 150 million tokens sent from Tether's treasury went to Binance. But why print more stablecoins when there are already billions in circulation? Here's a thought experiment for you. Imagine the crypto market is crashing. Everyone except hardened hodlers are rushing to trade their Bitcoin, Ethereum, and whatever other cryptos they have for a stablecoin like USDT to prevent further losses. Some clever traders on exchanges have set up limit orders to sell their USDT for slightly more than $1. On a normal day, that premium USDT would never sell because nobody would pay more than $1 for an asset that is backed by $1. However, today isn't a normal day. There's blood in the streets and people are desperately trying to cut their losses. Demand is high, really high. All of the USDT that was being sold for $1 is sold out on multiple exchanges, meaning the only choice for most traders looking to cut their losses is to buy USDT at a premium. And many people will gladly pay that premium because they think the cost of holding on to whatever crypto they have could result in an even greater loss. The end result of this huge demand for a stablecoin is a visible spike in the price of that stablecoin. During the March flash crash, demand for stablecoins pushed Tether off its peg to over $1.05 per USDT. The opposite effect happens during a bull run. If Bitcoin and Ethereum are going parabolic and everyone is trying to sell their stablecoins to get on the rocket ship to the moon, that sudden flood of supply can temporarily push the price of a stablecoin below its $1 peg. Upon close examination, it looks like the largest stablecoin issuers are implementing their own monetary policy on a small scale to maintain their $1 peg. When you overlap the circulating supply of Tether with its price in USD, you can see that USDT is minted every time price has been frequently going over the $1 peg. And you can see that USDT is burned every time price falls below the $1 peg. Minting USDT prevents clever traders from pushing up the peg by selling USDT at a markup on exchanges when demand is high. And burning USDT ensures that the excess supply doesn't devalue USDT when demand is low. If you follow any whale transaction trackers such as Whale Alert, you've probably seen these stablecoin mints and burns in real time. You might have also noticed that USDC tends to burn tokens frequently compared to Tether, and tends to mint them in smaller amounts. While this is probably because they have to put a bit more effort into their monetary policy as a stablecoin with more demand volatility, their supply management has also resulted in a more stable peg to the US dollar. USDC's solid monetary policy is probably why it has recently been growing at an even faster rate than Tether. If you want to learn more about USDC, USDT, and other top stablecoins, then you can check out my top 5 stablecoin picks right here. The ability to burn supply is one of the biggest differences between stablecoins and the fiat currencies that they're pegged to. The Fed can only print more currency. They can't go out and start burning bills to reduce the supply when demand is low. As entertaining as that would be to watch, it would be objectively difficult to do because the money is spread out between many different parties and institutions that are all disconnected and, in some cases, blatantly uncooperative. In contrast, much of the cryptocurrency space is connected by blockchains, and its centralized institutions often work together very closely. Stablecoin issuers can work directly with cryptocurrency exchanges to manage the supply of their stablecoin tokens. It seems to me that that's exactly what they've been doing. So, this begs the question that I'm sure is on the tip of your tongue. Can stablecoins be used to manipulate the price of Bitcoin or some other cryptocurrency? After all, didn't Bitfinex use Tether to spark the 2017 to 2018 Bitcoin bull run? Whether Bitfinex manipulated the price of Bitcoin using Tether in 2017 is quite frankly something for the lawyers to figure out. If there was manipulation there, I would be surprised if it had any significant effect on the price of Bitcoin or any other large cryptocurrencies. Now, this doesn't mean that exchanges don't do wash trading with stablecoins to create fake volume and price action. That does happen, and many of us know how to spot wash trading and know who the usual suspects are. This sort of market manipulation usually happens with smaller cap cryptocurrencies which do not have very much influence in the crypto space. The price action of almost every altcoin is dependent on Bitcoin for the time being, and unless all of the largest exchanges inflate the price of Bitcoin in a coordinated manner, it's probably not going to have a very big effect on the market. Indeed, that is exactly what my detective work uncovered. There doesn't appear to be any tangible evidence that stablecoins can be used to inflate the cryptocurrency market. This all comes down to another factor which separates stablecoins from the fiat they're pegged to: redeemability. As I mentioned earlier, stablecoin issuers mint and burn tokens to maintain their peg. While a high demand and a low supply might mean you'll be paying a premium on USDT, a low demand and a high supply could present a serious arbitrage opportunity for traders. The two largest stablecoin issuers, Tether and USDC, actually allow you to redeem your tokens for real US dollars. There are special conditions there, of course, such as KYC and a minimum withdrawal amount plus a withdrawal fee. However, if the price of USDC was to drop, say, below 90 cents, this means that someone could buy up a bunch of USDC at a discount, go over to Circle's website and demand their $1 peg. This means that any excess supply that the Circle fails to burn is shoved down their throat by arbitrage traders. In other words, the amount of stablecoins you see in circulation are, in theory, necessary. Stablecoin supply is fundamentally an indicator of demand for cryptocurrencies as a whole, and not an indicator of market manipulation. But don't take my word for it. A study on stablecoins published in April this year by Vox EU found that there was, quote, no systematic evidence that stablecoin issuance affects cryptocurrency prices. Instead, their study suggests stablecoin issuance is based on deviations from their peg. As I just discussed, those price deviations occur due to mismatches in supply and demand. Even though stablecoins are not being used to pump up the crypto market, the stablecoin case is far from closed. Crypto traders and hodlers aren't the only ones who've taken note of the rapid growth of stablecoins. Governments have also started paying attention, and some of them are starting to roll up their sleeves and show off their regulatory arms. At first glance, this is a bit odd. After all, most stablecoin issuers are centralized and regulated. They already work closely with law enforcement and blockchain analysis firms to keep a close eye on where their tokens are. So, why are governments so worked up about stablecoins? Well, there are a few reasons. First, the largest stablecoin issuers are all based in the United States. If a European or Asian government wanted to get access to stablecoin data, they would have a hard time getting it. The process to request and receive that information is lengthy, costly, and incredibly inefficient. This is why the European Union wants to force stablecoin companies like Tether and Circle to register in an EU country. This would put that stablecoin data within arm's reach of European regulators. If these stablecoin companies fail to register, it might just become illegal to hold or trade against stablecoins in Europe in the next few years. What's more is that these regulations would be pretty easy to impose, since all cryptocurrency-related companies operating in Europe must collect KYC documentation. While some traders may just opt to switch to using decentralized exchanges where KYC is unnecessary and stablecoins are abundant, the absence of stablecoins on centralized exchanges would wreak havoc on the European cryptocurrency market. And this could harm the crypto market as a whole. Now, for what it's worth, I think Tether, Circle, and other centralized stablecoin issuers seem willing and able to work with governments and regulators in other countries. The European Central Bank also claims that it's concerned that there will be a, quote, run on stablecoins. This is where people try to redeem stablecoin tokens, only to find that stablecoin issuers do not actually have the fiat which backs those tokens in the bank. This could bludgeon the cryptocurrency market and potentially drag down global markets as well. That's a scary thought, until you take a look at the reserve requirements for banks around the world, that is. Now, in case you didn't know, a reserve requirement is how much cash a bank needs to have on hand relative to how much money the bank holds in total. For example, if a bank holds $100 million and has $100 million of cash spread across its various physical branches, that would be a reserve ratio of 100%. Most banks around the world have a reserve ratio of 10% or less, and some have no reserve requirements whatsoever. Now, that is terrifying. In contrast, stablecoin issuers like Tether and Circle are regularly audited to ensure they have enough money in the bank to back their tokens that are currently in circulation. While Tether's reserve ratio is questionable, Circle seems to have been spot on, and it's probably part of why USDC is gaining in popularity. In any case, the risk and damage of a run on banks is far, far greater than the risk and damage of a run on stablecoins. What this suggests to me is that the European Central Bank is probably not really all that concerned about stablecoin runs, but is instead concerned with the threat stablecoins could pose to the euro. Stablecoins are basically a central bank digital currency without a central bank. Because there is open competition, it forces stablecoin issuers to ensure their tokens remain stable, available, and redeemable. In other words, it forces them to have a very good monetary policy. In response to the current financial crisis, governments around the world have been printing money like crazy. As we all know, this inflation is bound to devalue a currency sooner or later. However, not all money printers are created equal. The US dollar is the world's reserve currency. This means that the demand for dollars around the world is much higher than for euros or any other fiat currency at any given time. The US dollar also has a larger supply than any other fiat currency. What this means is that if 1 trillion US dollars and 1 trillion euros were printed, the euro would experience more inflation than the US dollar and lose value relative to the US dollar. Whatever it is that causes the euro to drop, if the euro started to lose too much value, European citizens might become tempted to trade their euros for US dollars to hedge against further losses in purchasing power. Historically, there were many hurdles to this. European banks could charge premiums on USD exchange rates to deter people from selling their euros. Opening a US bank account from overseas, or even trying to open a US bank account with a European bank, could likewise be difficult and expensive. And holding US dollars in cash would not do you much good in a country that's still accepting euros. Today, you can download a mobile wallet in 5 seconds, instantly generate a stablecoin address, and use your debit or credit card to load your de facto US dollar bank account with US dollar stablecoins. What's more is that you can spend those US dollar stablecoins at almost any European merchant using a cryptocurrency debit card or a mobile crypto payments app with a digital NFC card. In short, stablecoins make US dollars readily accessible to anyone with an internet connection. This threatens the stability of foreign currencies because the moment they start to lose value, their citizens can easily accelerate that devaluation by selling their native currencies for US dollars. In a worst-case scenario, this could completely tank another national currency, making the affected country's economy heavily dependent on US monetary policy. Could this be the secret economic endgame for US dollar stablecoins? I might just have an answer to that in an upcoming video. Alright team, that's enough detective work for today. Time for a few closing thoughts. As it turns out, stablecoin printing is probably not being used to manipulate cryptocurrency markets. Stablecoin issuers simply print and burn tokens to ensure supply keeps up with demand. This is to maintain their one-to-one peg with the fiat currency they are backed by. The huge increase in supply we've seen over the past 6 months is fundamentally nothing more than an indicator of an increased demand for cryptocurrency as a whole. This is because stablecoins are used primarily as a hedge by traders. The sharp increase in stablecoin supply suggests that either existing traders are adding to their portfolios or that new traders are coming into the crypto market. As we know, it seems to be a bit of both, and both new and existing traders are getting hungrier and hungrier for stablecoins to hedge with as new money pours in. Issuers like Tether and Circle are just printing to keep up with the demand. This printing is making governments nervous, especially foreign governments which are not able to easily access databases from centralized issuers and work with them to fight crime and tax evasion. They would also like to know where all the USDT or USDC is being sent, and warn that they will clamp down on the stablecoin market if issuers do not set up new bases of operations in their jurisdictions. The dominance of US dollar stablecoins may also pose a threat to foreign currencies. Cryptocurrency makes it possible for anyone to create their own virtual US bank account, which can be loaded with USD stablecoins. And the rapid growth of cryptocurrency debit cards and mobile crypto payment apps could potentially devalue other national currencies. In fact, that might have been the secret stablecoin plan all along. To be continued. If you enjoyed watching this video as much as I enjoyed making it, then be sure to smash that like button, please, my dears. Remember to subscribe if you haven't already, and ping that notification bell so you know when my next crypto briefing hits the tube. Hungry for more? My weekly newsletter is an all-you-can-eat buffet of the best crypto treats, tricks, and resources to help you keep up with the crypto market. Just head on down to that first link in the description to subscribe. Once a week only, no spam. I am a modest man. And with that, I'll see you next time. Take care out there.